Hey everybody, welcome back to another edition of 5 Question Friday. This is where I attempt to answer questions you've sent in. We got 5 great questions for you today. By the way, this is my third attempt at recording this video. It's been one of those days, but enough of that. Let's just get to your questions. That's the important stuff. By the way, if you want to send in a question, subscribe to my newsletter with the link below this video. It's free, goes out every Sunday. And you can either, when you get that newsletter, you can either just hit reply and email me your question. Or there's a link in that newsletter and you can fill out a form. I'd love to hear from you. So with that, here are the 5 questions we're going to tackle. This is my third attempt to record this video, so I'm thinking the third time's a charm. We'll see. Number 1, are financial apps safe? Big, important question. We'll cover that first. Then the second question, a viewer named Ruth wants to know, wanted help with understanding the risks of some bonds that she inherited. And then we've got a question about mutual funds. A viewer saw that I have mutual funds in my taxable account based on my last portfolio update, I'm guessing, and very concerned about that. So we'll tackle that. A great question about annuities in retirement and generating retirement income. And then finally, a viewer named Krish asked me about a Ben Felix video. He's another YouTuber, great content. I love Ben's work. But I formed the question, does he hate index funds? He does not, I can assure you. But he did do a video discussing what he views as a pretty notable problem with index funds. And so we're going to cover that. And let's get started. So Kevin writes, I only recently started watching your YouTube videos, retired last September. Would you offer a comment as to whether Rocket Money or Empower is a better tool? And then really the focus of his question, are there any concerns about the security of users' data? And I would say really users' investment accounts. That would be my big concern, right? So first, just briefly about Rocket Money and Empower. So I've used dozens of tools, both for budgeting, retirement planning, investment tracking. I've used Rocket Money and Empower extensively. They really serve 2 different purposes. Rocket Money is a budgeting app. It's a very good one, I think. It's reasonably priced, great mobile experience. I like it a lot. You can connect investment accounts, but really all you get is your balances and some performance data. It's a budgeting app. Empower is just the opposite. Can you track your spending? Yes, and I did for years. They have a cash flow tool, and you can categorize your spending and tag it as well. And if you just sort of want to know where your money went, it's great. But it's not a full-fledged budgeting app. You're not going to be able to budget in a forward way. It doesn't have a lot of the bells and whistles that budgeting apps have. But it's great for investments. It tracks, of course, your balances and your performance, but your asset allocation, your investment fees, and all of that ties into, I think, a pretty good free retirement planner. So it's not that one is better than the other. I think they're both good. I'll leave a link below the video where I talk about a lot of these sorts of apps that you can check out. All right, but what about safety? So I have never encountered an issue with safety in terms of connecting accounts to any of these budgeting apps or investment tracking apps or retirement planners, nor am I aware of any. Like I've never heard of someone saying, I connected my account to a budgeting app and they stole all my money. I've never heard that. Now, maybe it's happened. Maybe you've had a security issue when you've connected an account. If you have, please leave a comment below this video and let us know about it. But I've not heard that. And I want to show you what it looks like to connect an account. I'm going to use Boldin. This is just a retirement planner that I use. This is a demo account. This is not my actual retirement plan. But in Boldin, you'd go to this connection tab here. And this is where you can connect accounts. And it's important to understand how this works. And it's why I have confidence myself. Again, you'll have to make this decision for yourself, but why I'm confident about connecting accounts. And just follow the tabs here. And they use Plaid. Yodlee's another one. These are industry standard tools to connect accounts. Well, we could pick any of these, but I'll just do Robinhood. And it's going to pull it up. If you've used Plaid in the past and you put your phone number here, it could pull up connections that you already have with Plaid. But I'll just continue as a guest. And when I do that, I've got to put the name back in, Robinhood. Here it is. So I'm going to pull this. Well, first of all, when I click this, it'll just take me to a screen that says, OK, you continue to log in. So let me pull that off the screen for just a second. All right. This is what comes up. And I can put in my login credentials for Robinhood. But notice where I am. I don't know if you can read it, but the URL is a Robinhood.com URL. I'm not on Boldin's website. I'm not on Plaid's website. And if you research Plaid, they will tell you that they do not maintain your credentials. Your credentials are only being entered on the Robinhood site. And what I found, by the way, if you have two-factor authentication, which I highly recommend, you'll have to use that two-factor authentication as well. And this is all, in this case, within the Robinhood, ecosystem and their website. And that would be true same if you were going to connect Fidelity or Vanguard or Schwab or whatever. And so I feel, I guess anything could happen, but I don't personally have significant concerns about linking these accounts. That's just one of the reasons, but I wanted to show you that. Again, though, if you've had issues, I really do want to hear about it. You can shoot me an email or just leave a comment below the video. But there you go, Kevin. That's my take on your question. Number 2, Ruth has questions about the risk of bonds. And what she says is she's reading about how there's a possibility that bonds will go down because of the country's debts and central bank issues. It seems in any case, bonds drop. Is that true? Absolutely. Bonds go down in value and they go up in value, just like stocks do. Absolutely. Now, Ruth inherited some corporate and municipal bonds. Some come due 5 years from now in 2030. Some come due another 20 years later, roughly 2049. She wants to understand the risks. She says she's about 2.5, 3 years out of retirement. So it's a great question. And here's how I think about the risks of bonds. And this, by the way, is really true whether you're dealing with individual bonds, which is what it sounds like Ruth is, or even bond funds, but there's some differences. But we'll talk about three risks today. The first I'll just quickly mention is credit risk. So credit risk is just a fancy way of saying the risk that the borrower won't pay us back. They won't pay our interest on the money we've lent them, because that's what a bond is, right? We're lending money to a government, to a corporation, to a municipality. They don't pay us the interest they owe us, or when the bond matures, they don't pay us back our money, whatever amount is the face value of the bond, let's say $1,000. That's credit risk. Now, with U.S. government bonds, we generally say there's no credit risk. I'm not getting into the political discussion on that, but it's about as risk-free as we're going to get in this life. With corporate bonds, it depends. If you're dealing with what's called investment-grade corporate bonds, I won't say there's zero credit risk, but it's really, really low. So think if you've got a bond issued by Apple, very solid company with billions of dollars in cash. I guess anything could happen, but I wouldn't lose sleep myself over the credit risk of a bond that was issued by Apple. On the other hand, there are some companies that are on shaky financial footing, and it doesn't mean they're going to go bankrupt either now or any time, but there's a greater risk of default. And so I don't know what kind of bonds, corporate bonds Ruth owns, but that would be something to look at. Same with municipalities. Just depends on, with municipalities, where the revenue is coming from that will pay for the bonds. You might issue a bond to build a bridge, and the revenue to pay back the bonds, the interest in the face amount, will come from tolls that are charged for that bridge, or maybe it's going to come from tax revenue. But so there could be some issues there, credit risk issues with municipalities. You just have to understand the specifics of those bonds. That's issue 1, credit risk. Issue 2 is interest rate risk. This applies to any bond, and it's just that the risk that interest rates will go up while you hold the bond. So let's say you buy a bond that's paying 3%, and a year later, a similar bond is now paying 4%, and you decide to sell. Well, you've got this 3% bond, and the buyer says, wait a minute, I can go get a similar bond that pays 4%. Why would I buy your bond? Well, it's a good question. So what you're going to have to do, let's say it's a $1,000 face value bond, and what I mean by that is when it matures, the owner of that bond will get $1,000 back. Okay. The buyer will say, well, look, I'll buy it from you, but since I'm only getting 3% from your bond and I can get 4% from a new bond, you need a discount. I'm not going to pay you $1,000 for that bond. I'll pay you, and there's a formula. We'll just say it's $975. You're going to sell it at a discount, and that discount for the buyer makes up for their willingness to accept the lower interest rate. And so, yes, bond values go down. Of course, the same thing could happen in reverse. Maybe interest rates go down, the value of bonds could go up. Now, that interest rate risk grows the longer the maturity of the bond, right? So if she's got some bonds that don't mature until 2049, that's a long time. And if interest rates go up a lot, the value of those bonds could go down significantly. And again, I think it makes sense if someone said there's a 3% bond and rates have gone to 5%. Oh, that's not good. Or you're stuck with a 3% bond. But they say, well, I am stuck with it, but it matures next week. Okay, well, that's not that big of a deal. You're going to lose a little interest for 5 days. On the other hand, if it doesn't mature until 2049, that's a much bigger deal. And so the not all bonds have the same interest rate risk. Generally speaking, the longer the maturity, the greater the interest rate risk. It's a little more complicated than that, but for our purposes, that's the thing to keep in mind. Now, as Ruth pointed out, she could just hold the bonds to maturity. And again, assuming that there's no credit risk or that they don't default, she'll get the face value of the bond back. And between now and then, all the interest. That's an option for her. And then the third risk, and I mentioned this in particular, it could certainly apply to corporate bonds, but it definitely could apply in municipal bonds. Bonds can be callable. All that means is the borrower, the municipality in this case, could say, the bond doesn't mature for 10 years, but we're going to give you your money back now. Thank you very much and have a nice day. And why would they do that? Well, let's say they're paying you 5% and interest rates fall to 3%. Like, well, I'm going to give you your money back because I don't want to pay 5%, and I'll go issue a new bond and only have to pay 3%. Of course, from an investor's perspective, that's a real bummer, right? Because you were enjoying 5% yield, and now that's gone. So if the bond is callable, that's an added risk. And so you just need to evaluate the bonds. Now, by the way, the fact that a bond is callable doesn't make it a bad investment. In fact, all other things being equal, you might get a little bit higher yield. You should, if you're going to take on the risk that the bond will get called. By the way, one way to think about a callable bond is just refinancing a mortgage. It's the same thing. That's what we do, right? We're paying a bank 7% and rates drop to 5%. Yeah, we're going to refinance. Municipalities, corporations, they do the same thing. By the way, U.S. government bonds used to be callable. I want to say that changed in the 80s, but I could be wrong. In any event, that's the deal. Credit risk, interest rate risk, and I think callable bonds, you want to think about that risk too. Again, what Ruth should do, I can't answer that question, but those are how I think about the risks. And they're true with a fund as well. If you invest in a municipal bond fund, it's all of the individual bonds in that fund, some of them might be callable, and you'll have that same risk. But great question. Hopefully that helps. All right. Whew. Question 3. Here was the question. Apparently this comes from my last portfolio update. This viewer noted that I have mutual funds in my taxable account. That's true. Doesn't it mean one would need to handle the taxes associated with dividends each year? Am I missing something? You are not. Absolutely, I pay taxes on the dividends. I'll show you an example. And this is true whether we're talking about a mutual fund or an ETF. I'll just use the ETF version of Vanguard's Total Stock Market Index Fund. And if we go to performance, and then we go to distributions, we will see green is income that they've distributed each year. That would be dividends in the case of a stock fund, interest in the case of a bond fund. If they distribute any short or long-term capital gains, they'd be in blue. We don't want that. That would be bad. And return of capital, probably not much of an issue for an index fund, but some funds do return your investments back to you. And we can see that we'll just use 2024. It paid $3.67 per share for dividends. Now, I don't mind that. That's going to be taxed as, for the most part, long-term capital gains, qualified dividends. And it's a pretty small amount because we compare that 367, I compare it to the ending NAV at the end of 2024. So 367 into 294, it's not much. In fact, if we go to the quote page, it's roughly around its current yield, I would say. I didn't do the math, but 1.3%, it's a very efficient, I think tax efficient investment. So I'm very happy with the mutual funds that I have, but I just don't think I think it's fine. But yeah, I do. I pay that tax every year. All right. How should we think about annuities for retirement? This is an involved question, but it's an important one. Let me read the question to you. I recently came across your YouTube channel. I'm 70, retired recently. I've got Social Security. I need another $5,000 a month from savings. My advisor from a large brokerage firm said, hey, let's put a third in a guaranteed income annuity ladder for 10 years and invest the rest in a large cap dividend equity fund. And then the basic question that this viewer asks is, look, I've got some questions about annuities and I'm not sure about this. What do you think? Of course, I can't tell anyone what to do, nor would I try. But if I were talking to this viewer and the advisor, I would have some questions. And let's just sort of walk through them. First, I would say, you're 70. From a retirement planning perspective, how long are you planning for? And I don't know the answer. Let's just say 95. Okay, you got 25 more years. All right. That's question one I'd want to know. Two, do you have any other, at the moment, any other guaranteed income other than Social Security? I'll just assume the answer is no. Then I'd want to know, okay, you need $5,000. Is that for the rest of your life? And the reason I ask that, I mean, I would assume that it is, but I don't understand it. Why a 10-year ladder? That would be the question to the advisor, I guess. What's special about 10 years? If the answer was, oh yeah, this 5,000 is for a very specific thing that just lasts 10 years, okay, maybe a ladder makes sense. But if not, if it's 5,000 for living expenses, that's what they need over and above Social Security, I guess I don't understand the 10-year ladder. Now, maybe they would say, there could be an answer. They could say, well, it's just going to be a sort of what I'll call a rolling ladder. We're not spending all that money when each annuity comes due each year. We might take that money, invest it in another 10-year ladder. I guess that's possible. But then my question would be, why all the work? That just seems like a really complicated way to do what could be really simple. And why an annuity? It's not necessarily that they're unreasonable. I'm guessing this is a multi-year guaranteed annuity, but I don't know that. I think it's got to be, but maybe it's some other annuity product. But why are we doing that? Why not just a bond fund? Maybe a TIPS fund and just a nominal bond fund. Seems much easier. But those would be questions. I would want to know that 5,000. What percentage of the person's savings is that? Are they taking out 4%? Does that represent 4%, 6%, 2%? Because that's going to drive a lot of the decisions on what would be a reasonable asset allocation, for example. Right now, if we think about the annuities as it's a form of a bond, it's 1/3 bonds, 2/3 equities. That may be perfectly reasonable, but what's the thinking on that? What's the basis for that? And for me, the primary question there is, what percentage of their savings does that $5,000 represent? If it's 1 or 2%, well, truthfully, they could invest it just about any way they wanted to, and they'd probably be okay. If it's 5 or 6%, that's a different issue, and so it raises different questions. The other thing I'll mention, and I know I'm asking more questions than I'm answering, but that's how these things go. I really like the idea of having your necessary living expenses covered by, if not all of them covered by, a lot of them covered by some form of guaranteed income. Social Security and an annuity, that might be reasonable. But I wouldn't use an annuity ladder. I would just buy a single premium immediate annuity. Now, it's, there's some questions to ask and to think about. You have to think about the amount because annuities are not indexed for inflation. That's one. You have to keep in mind that when you die, the money's gone. There's nothing for your family to inherit, and that may or may not be important to you. And then the question is how much you need to invest. Now, if you need $5,000, you could buy an annuity that generated $5,000 a month. And you say, yeah, it's not an index for inflation, but my spending's probably going to go down over time. Studies show that as we age, it does, even factoring in healthcare expenses. Plus, hopefully you have some money beyond that still left that you're investing, and that maybe that could cover some of the inflation. So there are questions to be considered and answered here. And a lot of folks will say, annuities just aren't for me. I'm okay risking things in the market because I've got a good stock bond allocation. Maybe I have some cash set aside as well, and I'm fine with that. It's in many ways a very individual question to answer. I don't think there's one right way, but those are just some of the questions that come to my mind when I read this viewer's email to me. There you go. Hopefully that's helpful. Now to Ben Felix video. Here it is. There's Ben. The problem with index funds. So I'll just summarize this for you, but I'll leave a link to the video below. Great video. I enjoyed it. I watched the whole thing. I'm familiar with most of the researchy sites. There were a few new things that I pulled up and read. Here's the basic point, that index funds are, of course, tracking an index. And that requires an index fund to buy and sell. So, for example, maybe you're the Vanguard Total U.S. Stock Index Fund, and a company issues an IPO. They go public. It's a new company. It gets added to the index, so you have to go buy it, you being the index fund, because you're going to track the index, right? Well, that often causes index funds to buy or sell at inopportune times. It's often not the best time to buy at an IPO. That's when all the excitement, they're selling these shares often at somewhat inflated prices. And so the index fund is sort of forced, if you will, to buy them and not maybe not the best time. Or maybe it's the S&P 500 index and they've announced that they're removing 5 companies from their index. And of course, what happens when that is announced? Prices go down because people sell that stock, those stocks. But the Vanguard and other S&P 500 index funds haven't adjusted yet, right? Because this gets announced ahead of time. So by the time the index fund sells, the price has gone down. They're selling at a bad price. And the reverse can happen. Maybe the index announces they're going to add 3 new companies. What happens? Price goes up. So by the time Vanguard gets around to buying it, they're paying an elevated price. That's effectively the issue that Ben is describing in his video. I don't take any issue with that. It is an issue. It is sort of the reality of tracking an index. Here's how I think about it. Imagine we wanted to tail a car, and we're right on their bumper. And it slams on the brakes, we slam on the brakes. It takes off, we take off. Sharp turn to the left, we turn to the left. And it's a lot of wear and tear on our car. It's wearing our tires down, our brakes, and that's costing us a lot of money. That's basically the issue that Ben is describing with index funds. And so what could we do about it? Well, we could just back up a bit. Maybe we don't need to be right on the car's bumper. Maybe we can be 2 or 3 car lengths back. And then we don't have to slam on the brakes when it slows down to get rid of a company out of their index or accelerate at a high rate when they add 3 new companies. We can take our time. We still see the car up ahead. We're not that far behind it. And if it takes a turn, okay, we can take our time. We'll take the turn. We'll get there. We're just not on its bumper. And maybe we won't have all the wear and tear on our car. Or in the case of index funds, maybe we won't be buying and selling at these inopportune times. Well, that sounds good. But then it raises a question. Exactly how close to that car in front of us should we be? Exactly when should an index fund make the purchases and sales to keep track of the index? How much should it wait? And of course, if you do historical studies, you won't get the same answer every time. You won't get the same answer with different index funds. In different time periods, they should have held back 2 car lengths. At other times, they should have held back 4. Maybe sometimes they should have been right on the bumper. It's not so simple. Having said that, the studies do say, yeah, you lose a little bit because of this. At the end of the day, for me, if the point is index funds aren't perfect, I'm right there. I agree with you. They're not perfect. I have yet to find a better alternative, and I think they're really, really good. If I were going to list out the top 100 concerns I have about investing, saving for retirement, building wealth, where would this issue be on that list? The answer is nowhere. It wouldn't make the top 100. I just think it's an issue that is really just not an issue that we need to concern ourselves with. That's my view. Maybe Ben feels differently. That's okay. Maybe you do too. Now, I'll end the video, and I know you're thinking, thank goodness, Rob. Right. I'm going to show you a fund that he mentioned in his video. DFUS. This is a dimensional fund. It's an ETF. And apparently, they try to do this. They try to not tail the car so closely. And his point was, he said, look, it's only been out since 2001. We can actually go to the chart. And if we hit max, you can see 2021. And since that time, he says, it's outperformed VTI. Now, for data type, I want to look at growth with dividends. And we're going to put VTI in. But something's going to change. You may not have noticed it, but now we're going all the way back to 2001. What gives? So DFUS is an ETF. It was launched in 2021, but it replaced an identical mutual fund. And that mutual fund actually launched all the way back, I believe it was September 25th, 2001. And Morningstar has all of that data. And if we go back to 2001, it turns out that VTI has not underperformed DFUS. It has outperformed. Now, not by a lot, right? And they were neck and neck for a very long time. But actually, VTI has outperformed. Now, my takeaway from this, though, is probably different than you might think. I actually think comparing DFUS and VTI doesn't make a lot of sense for me. Why? Because DFUS is not a total U.S. stock fund. In fact, if you go to their Dimensional site and you look at the prospectus and their website, they specifically say we're excluding certain aspects of the market, including, by the way, small cap or large parts of small cap. And so it's not really a good comparison. In fact, if we go back to the portfolio of DFUS and we look at the number of equity holdings, they've got 2,500. Well, VTI has like 35 or 3,600. We can look at it real quick. I just don't think, to me, I just don't get any meaningful data out of comparing these two funds. Yeah, they're almost 3,600. DFUS could be a great fund. I don't take any issue with that fund at all. I've never owned it, but that's so what, right? But at the end of the day, I think index funds are great. You know, if products come along and maybe can deal with this issue that Ben has raised in a way that maybe gets us 5 or 10 or 15 more basis points, I'm all for it. But frankly, I just don't think it's an issue, not one that I'm going to worry about in any event. And but there you go. That's my take on the video. By the way, a very informative video. I highly recommend that you watch it. I enjoyed it immensely, and I enjoyed reading a lot of the research that he cited. Excellent work. So there you go. That's my take on that question. Well, I appreciate you listening. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And again, if you've had any security issues linking accounts to apps, please leave a comment below the video. Let us hear about it, or just shoot me an email. I'd love to hear your story. And then other than that, I got nothing else. So until next time, remember, the best thing money can buy is financial freedom.